Welcome to the Cash Flow Champs podcast, the show where we demystify real estate investing so you have the tools you need to gain financial freedom through passive investments in real estate. And now your host, Cash Flow Champs Managing Partner, Prashant Kumar.
Welcome, everybody. This is Prashant Kumar and Paul Senior from Cash Flow Champs. And today we have with us a very distinguished guest, David Lindahl. Dave, thank you so much for joining. Welcome to this podcast, Cash Flow Champs Real Estate Podcast today.
My pleasure, Prashant. Good to be with you again.
Sounds good. We talked probably in November during our summit, but today we are gonna talk about real estate. What is the current state of the market? But before that, let me formally introduce you to the speakers. Those who don't know much about you, most of the folks know about you anyway. Dave has been in real estate industry for a long time. He's a coach, motivational speaker. He's a sponsor. He started with a rock band, and from rock band he came into landscaping business. From landscaping business he came into single family homes business, and from single family homes business he came into apartments. Within a span of 14 months in real estate, Dave was able to create a cash flow for himself for about $15,000 per month. At one point in 3.5 years, he had about 9,000 doors. And then he started this RE mentor group. His sole purpose in life is to educate people and make them financially free. He has been author of 2 iconic books, Multifamily Millions and Emerging Real Estate Markets. We are so honored to have you, Dave, with us, and hope we'll dive deep and ask you difficult questions today.
All right, listen, I got to correct that sole purpose in life. I have dual purpose in life. The first one is to increase and create additional generational wealth for my family. That's always number one.
That is correct.
Number 2, to help everybody else on their journey as well.
That is awesome. I've seen awesome. You. I have attended your seminars, boot camps many times, even though you have not been my formal mentor, but I have learned a lot indirectly from you, Dave.
Yeah, you know what happened, Prashant? Is 6 years ago I had kids. So 6 years ago, after teaching for 12 straight years on the road, I decided I wasn't going to travel anymore. I was going to stay home and raise my kids. So I have got 3 beautiful kids, and I'm at the Ultimate Partnering event live, and I'm with the Insiders Club. That's it. We've got a great studio downstairs where we do virtual teaching, but I like going home at 5 o'clock and having dinner with my family.
That is awesome. Hopefully we can also do that. Just a little bit about myself. I come from IT industry. I have managed folks around the country. I worked morning 8 to evening 8. And now I'm in real estate full time, CCIM, and I still have that habit, morning 8 to evening 10 kind of work, but I want to get out of that pretty soon,
Yeah. So Dave, you touch on it a little bit. Can you delve into that a little bit more? What inspired you to get into the multifamily asset class, and how did you get in?
Well, first of all, I love this question because people ask me, what was it that changed your life? What was that defining moment?
Right. Yeah.
And it wasn't like one defining moment. I was just tired of being broke. I grew up poor, and I was the lead singer in a rock and roll band. I left that band, started a landscaping company, trying to make it, and I thought $50,000 a year was making it. I thought it was awesome. Right. And then I started doing clean outs for houses, and we found a Get Rich in Real Estate course during that, and I started listening to it. And I thought, wow, this sounds pretty good. There's an old Culture and Sheets course. I was like, oh, this sounds pretty good. Maybe I'll start doing that. And that's when I saw a biography on a guy named Harry Helmsley, who started buying multifamily properties in New York City when he was broke and ended up owning the Empire State Building. And he said, what I love best about apartments is that your tenants pay for your management company, so you don't have to answer any phone calls or collect any rents. They do it. They'll pay for maintenance guys to swing the hammers and take out the trash, and they'll pay for they'll give you enough money every month. They pay down your mortgage every month, so they pay for your mortgage. And then at the end of the month, they give you so much money that after that's all paid off, then you have extra money. It's your personal cash flow that you can reinvest, put into a savings account, or just go out and have a whole bunch of fun with. And I thought, man, if that's really true, I want in.
Sure, absolutely.
Yeah. 9,000 units later, it's true.
Wow. And if you're going through all that from 0 to 9,000 units, I know you probably face some challenges along the way. What are some of the challenges you faced during the early stages of your real estate journey? And how did you overcome those, Dave?
Yeah, I had a lot of challenges. I made a lot of mistakes. I had a lot of fear at the beginning because there was nobody out there teaching. Like now there's a lot of people teaching it. At one time I was the only person teaching it. But then when we started, there was nobody teaching it. So it took me 9 months to get into my first deal, even though, and the way I learned is I learned through a really good mentor who was a very conservative multifamily investor that was in my real estate investment club. And then there was 2 or 3 other guys that were investing in multifamily that I would take to lunch and pick their brain, and they were very helpful for me. So I appreciated that. But even though I had their support, I was still afraid to do my first deal. And then finally banged it out. I actually asked my best friend to do it with me because my father told me, it was going to be a disaster. I was going to go broke. Hey, you're going to go down, Dave. You're going to go down. He had this hand signal. And I would have dinner with him every Monday night. And sometimes he would just look at me, not say anything, and just keep So I was really nervous. So I said to my friend, who was just as broke as I was, how would you like to invest in multifamily properties over in Brockton? Because the market's such that you can buy them for below replacement costs and they still cash flow. And that's a recipe for success for anybody who's listening. If you can get them for below replacement costs and they cash flow 95% of the time, that's a really good deal. And at the time, that's where the market was in Brockton. And we started buying them after 9 months of going through the fear. After we bought the first one, we ended up with 3. 3 months later, we had 3. Within 6 months, we had 9. Within a year, we had 11. Within 3 years, we had almost 40 of them. And then from that point, the market started to change. We'd become wealthy in a short period of time. It was like, I was still living in a 1-bedroom apartment. And basically because I didn't have time to buy anything else, we were so busy. It was so great. It was the busiest time of my life. And yet I was making more money than I ever made in my life. So then the market changes and I have a choice, either cash out. I kept learning, it's a big process of learning. And I started learning about market cycles, and I learned that we were like getting near the top of our market, and I either needed to cash out and get to a cash position and sit through the decline phase, or move into another market that was in the emerging phase where I could potentially double, triple, or quadruple my equity instead of waiting in the decline phase. And I thought that was a better idea, even though I was really nervous about that because I had to travel. The market that I pinpointed was Montgomery. I learned to follow job growth. If you're taking notes, follow job growth, follow household formations. Look for markets that have a 2% year-over-year job growth and a 2% year-over-year household formation, not population, household formation. That's more important because those are the people moving in and they're going to rent from us. So Montgomery was a good place. They were building a Kia plant down there. 5,000 new jobs were coming in. The key about new jobs coming into a market is that there's always a multiplier effect. Montgomery was a market that had a very small multiplier effect. It was 3, but this still meant that 15,000 additional jobs were coming in, 3 times 5,000. 15,000 jobs were still going to come into the marketplace. And it was surrounded by floodplains, which is called a barrier to entry. That is good. Barriers to entries are it curtails building. Like if you go to Phoenix, the mountains are barrier to entry because you can't build well behind them. Even though flying out of there the other day, I noticed, how they are starting to go around the mountains now. But on the east and west coast, the oceans are barriers to entry. So the floodplain was a barrier to entry because you can't build there. So supply was going to remain the same. Demand was going up. That just means one thing: values would go up behind it, and that's what happened. And I learned how to play the emerging market game. And within, a relatively short period of time, 2 or 3 years, I was in 18 different markets. Playing that game. It was a lot of fun. It's crazy.
That's impressive.
A lot of fun.
So what is your take today? Today, a lot of investors have a lot of fear right now. What is your take today?
They should have had fear last year.
What should happen today?
Yeah, this is what's going to happen. So last year, there should have been a lot of fear in the marketplace. And the year before that, there should have been a lot of fear in the marketplace. But you had these people doing these crazy deals. They would go by my desk and I'd look at them and say, this is ridiculous. The bridge financing, the pref debt, in reliance on either a value add that probably wasn't going to materialize or the pref being replenished at the at the disposal of the property with the profits from the disposal. Very, very high risk investing. It's not what you want to do. So right now we are in transition. We were in 2009 all over again. Inflation caused this market change. The interest rates went up. The people that did bridge financing are in trouble.
Yes.
People that were relying on value adds are in trouble. And so that's the opportunity for us. Unfortunately, other people's trouble is opportunity for people that are prepared. And that's just what's happened. That's what happens in a market cycle.
But the sellers.
So we're in transition. But sellers are still not ready to decrease their prices. The smart sellers will. They understand where we're at, even last year, as the interest rate started going up, there were some sellers that would not renegotiate because of the interest rate increase, but the smart ones did, and they willingly accepted the lower price because they knew, we're going into a recession. We may not see these prices again for who knows when, we're going to be on the decline side. So there will be a time, even the compression, the cap rates are still compressed below the debt rate. And, cap rates have to go up and meet it and then exceed it.
Right.
And that's when it's time to run again. And that'll take about a year to do.
So do you think we're in the recession phase yet? Or you think, what phase of the market is that?
We were in the recession probably last quarter, if not the quarter before that.
Right. Yeah.
It started. The inverted yield curve. I mean, I saw a graph today. It's the highest inverted yield curve that's been since the 80s, since the guy that I follow was plotting the yield curve. So, it's extremely high. So the recession started. A recession is 2 quarters of negative GDP.
Right.
And that happened in the summertime and in the fall.
So where do you see the opportunity for the new buyers if the sellers are not reducing the pricing?
No, they will. So the opportunity right now is to get yourself ready for the next run. So it's to, secure your broker relationships, secure your manager, secure your team, decide on the market that you want to go on. Could be your own backyard, or could be, one of the markets that will probably take off fastest as we emerge again. And then get inroads in there. There are still deals out there to be had. It's just not, it's kind of like a Jiffy Pop popcorn, the Jiffy Pop, you shake it on your countertop and, all of a sudden it starts to pop. It starts to sizzle for us. And that's what's going on right now. It's like the sizzle, and then there's the pop, and then there's a pop. And those are the types of deals that people are doing, pop here, pop there. We've been doing that for like the last 4 years. I refuse to, this market should have reset itself during the last election, right after the last election. And then COVID hit, and it screwed up the reset. And then we had a very odd market during COVID. The thing that supported the COVID market was all of these office and retail investors that, realized that there's no opportunity in office and retail, and they came into our marketplace and inflated the pricing and compressed the cap rates.
See, fundamental thing is there are a lot of unrest. A lot of people are very agitated in the sense that they want to buy, but they are not able to buy. What is the message for them that how much should they test their patience? A lot of people are sitting on the sideline for, as you said, for last 3 to 6 months or maybe 9 months, but they want to buy. I mean, they're not able to buy anything because obviously the market has changed. What do you tell them?
Well, I mean, if you want to buy stuff in this market, it's all based on your relationships. If you got good quality relationships, there are still deals out there. I mean, we just had our Insiders Club meeting, and that's we've got 3 different levels of people there. People that haven't done a deal, people that are, we call them rainmakers, people that have between 3 and 1,000 units, and then magnets, 1,000+ units. And everybody's doing deals except for the doers. The doers are the ones that just want to get into a deal. And they meet 2 days separately. But the rainmakers and the magnets, people are still doing deals. They're certainly not doing as many. We have this expression in our Rementor, staking a flag in a market, stake a flag in an emerging market, run in that market for 3 to 5 years, and then as you establish yourself, stake a flag in another market. There's no markets to stake your flag in right now. They're one-off deals, but those one-off deals are dependent upon the quality of your relationships with your brokers. So if you want to do some deals, create good quality relationships, and you'll get those off-market deals. That's the game right now. But so as the Jiffy Pop popcorn, pop a deal here, pop a deal there, then it starts to pop, starts getting a little bit faster. We'll see that like near the end of the summer, 3rd quarter this year. Then all of a sudden it's just going to be pop, 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 pop. And this like 2024, as we go into that, then we start running until probably 227, 228. And it's going to be awesome. And people like you and me and Paul Senior, we're going to have a boatload of properties. We're going to be exhausted, right? But we're going to have like a bank account's going to be big. It's going to be awesome.
Yeah. So you make mention of us seeing a decompressing cap rate and of course higher interest rate and lower LTV in properties, at least compared to last year this time, right? So how are these new conditions kind of affecting the acquisition process, maybe, for properties that you're dealing with and the type of terms you're getting from your lenders in terms of, how you can acquire properties in this current market, Dave?
We still go with conventional lending, Freddie Mac, Fannie Mae, CMBS if we absolutely have to use them. We try not to. So we still underwrite conservatively. We did just put a deal together last week. We're going through the due diligence now. We've got a couple other offers in now. So yeah, you just take into consideration what the interest rate is in your underwriting, and then you offer what you can. You offer what makes sense, and if the sellers aren't there, there's nothing you can do. You just move on.
What are the emerging markets do you think that will come up over the next year or so?
Well, I would look at Dallas. I would look at Orlando. I would look at Charlotte, Raleigh. I like those markets. I like Nashville. DC always runs first, but it's weird. DC and Minneapolis, Minnesota always run first. Why Minneapolis? I don't know. I haven't done enough into it. I've never really invested up there because I'm from Boston, and if I want to go visit my properties in the wintertime, I don't want to go to Minneapolis because it's just I like investing down in the South. So I like those markets. Vegas actually is going to come back fast. All the Texas markets and the markets in Utah, the two most business friendly states of all 48 states. Those are the ones, Ogden, Utah, Salt Lake City, Provo. Those are all good markets as well. And then there's going to come a point where the markets in California are going to start cash flowing. San Francisco, Los Angeles, San Diego, for a brief period of time, at the depths of this recession, you will see those markets cash flowing. And that window of opportunity, where there's more opportunity than usual, happens for maybe 4 to 6 months, and then it closes again. And then you really have to have, strong relationships to get deals done there.
What's your take about the Phoenix market?
Oh yeah, Phoenix too. I didn't mention it, but yeah, Phoenix is always a good market, because it has high highs and low lows. Like I said, I was just there. I was there for our ultimate partnering event. There's a ton of cranes up over there, just like here in Boston, there's a ton of cranes up. But yeah, if I could just, if there was a place where I would move to because I love the market, it would be Phoenix, Dallas. But in the lifestyle, those are good markets. And the great thing about Phoenix is that Tucson lags Phoenix by about 9 months to a year. So you just watch what's happening in Phoenix, and you just wait for it to happen in Tucson. So you can be ahead of the herd over there, which is good.
I mean, there is a little bit of lag happening in. Phoenix is obviously going down a little bit. Like Austin. Over the last couple of months.
Yeah.
How long do you think that could last? There are a lot of people who are positioning themselves to buy more in Arizona market. And these are some specific questions, but I'm just asking about.
Yeah, I don't know an exact time frame. All I know is that what will happen is the interest rates will stabilize and actually start to go down. The capitalization rates will start to go up. The sellers will start to realize that they're not going to get the pricing that they could have gotten the last few years had they sold. And then the market will face a kind of like an equilibrium, and then it will eventually turn into a buyer's market. More properties will start coming onto the marketplace because people are going to start losing them. And that's what's going to shift this market. When people realize, like when banks start putting properties on the market and they're looking to get, their money back, mainly, if they can get a profit, that'd be great. If they send it over to somebody like CW Capital to dispose of it, they could potentially get a profit, but they're just looking to get their capital back.
Right.
And so when these properties start coming onto the market faster, that's when the sellers are really going to have to, take inventory as to whether or not they're going to put their property on the market, and if they do, what the pricing is going to be.
In some way, you're kind of referencing maybe those bridge loans and stuff like that folks take out in 2019 and stuff like that coming due, and that may impact the market in a big way because the valuation may not be there, right? And so they really can't refinance out of it and things like that, and probably going to be a hard sell to get us those properties. What do you think about that?
That's already started happening. Yeah. So you can usually find your best price after a foreclosure. You can try to go in and negotiate with the banks, and sometimes you can on a pre-foreclosure and get it on a short sale. But most likely, you get if you go to the auction, and the auction price doesn't work out, buy it after. That's where you get it. Follow up with that bank. Find out which brokerage company they're using. That's the best strategy for those.
So, Dave, have you ever used international money in any of your projects? Any experience around that? International money, from Middle East or from Hong Kong or from China or from.
No, I have not. I know how to, I've been through the process. There was a couple of times where we thought we were going to, but it didn't work out in the end. So I actually met one time with a Chinese billionaire. I forget exactly where we met. I flew down to meet him. It was somewhere in the South. I think it might have been Nashville. I'm not sure, but so, he didn't speak English. There had to be an interpreter there. And so he was looking to move his money into the US because it was just, it was safer. And he wanted to move it into US real estate. And we're going to do business. But one of the things that was interesting that he said, I can't believe how orderly the streets are here. And I said, what do you mean? He says, in China, they portray everything as chaos in the United States. And it's not. Which I was surprised at too, because you don't, look at the perspective that other people have on the US, you basically live your daily lives. Yeah, you think you have an understanding of it, but you don't until you meet somebody like that. But anyways, no, I haven't. Did you have a specific question about that? I know.
I wanted to understand, I wanted to understand for our listeners also, to give them some knowledge, how can we bring international money into our syndication?
Prashant, you're Indian, right?
Yes.
So you must have contact with a lot of Indian money, right?
Yes.
So we should get together.
Yeah, no, definitely. If I could bring
the process.
Yeah, if I could bring the money, Indians are very, very meticulous. They don't want to give money to somebody else so easily.
Absolutely.
And same is the case with some other Asian cultures also. But I have seen a lot of money coming in from Middle East or European countries into United States. Countries like Israel. There are a lot of synergies. A lot of Israelis are, syndicators. They are doing business, sitting there, and they are doing business here.
We're working with an Israeli group right now. As a matter of fact, we thought we had a really good storage deal we were going to bring them into, but it kind of fell apart at the end.
Okay.
But yeah, I understand what you're saying. Somebody wants to, if you're dealing with an international group, they're not going to deal with you directly. They're going to deal through a confidant, somebody that they trust, that has the connection here. But let me tell you one thing. I had an Indian guy that used to work here. His name was Sunny. And my best friend married an Indian girl from Mumbai. So I went over for the wedding and in the engagement, and they showed us, Sunny showed us all around, and we needed to buy some stuff, right? I couldn't believe how everything, everyday life in India is a negotiation. I mean, everything was a negotiation. So whenever I wanted something, I would just say, Sonny, negotiate. And he was like,
that's almost the culture. In me, I would go to a store. I could even negotiate the copay with the doctor, for that matter, So that's like your blood, right? I was born and brought up in India.
Hey, I wish I had those negotiating skills. That was it's so intense. I would love to have my father drive that into me.
So
Dave, go ahead, Prashant.
No, you go ahead, Paul.
Dave, you've been at this for a long time, and I know it's been some victories and also maybe some challenges as you go along the way. For folks who are starting off, can you give them some advice there in terms of what is probably one of the challenges you have gone through, and that most people who are experienced go through, like yourself, and how did you overcome that type of a challenge in your career so you can continue to move on and reach the destiny that you are here today?
Let me tell you about my biggest mistake, and I'll also tell you in the 20 years of teaching, what I see the mistakes other people make.
Right.
The biggest mistake was I went too big too fast. I bought a 400-unit property in Huntsville, Alabama that was 26% occupied. Never should have bought it. I had already owned 800 units at that time. I had rehabbed a ton of properties here in Boston. I thought, 400 units is just like a ton of smaller properties, all just mixed together. I was so wrong. I didn't know what I didn't know. It took 6 years out of my life to run that deal as I'm trying to do other things, and it was just awful. So going too big too fast, especially in a repositioning, is a mistake that people will make. I was just on a call the other day inside of my own organization, and somebody asked me if they should do a 31 unit empty property. And I said, well, how many deals have you done so far? And they said, this will be my first. And I said, don't do it. Don't do it unless you have a partner, but it's a good deal. I said, listen, unless you have a partner that understands how to do those types of deals, don't do it, because you're going to waste a lot of time. It may not even be successful, and you're going to waste a lot of time if it is. And there's so many easier deals, momentum plays that you could have been doing in the meantime, making money.
Right.
So, so this is the advice for everybody. And I started teaching in 2002. I didn't learn this until 2005. I learned that it's much easier to do bigger deals, 100+ unit deals. So that's what I would teach, but I didn't just start doing 100+ unit deals. I started doing smaller deals, and I worked my way up, and because of fear. So when my people weren't as successful as I thought they should be, when I first started teaching, I was like, what am I doing wrong? Why am I not a good teacher? Because I knew the system worked. And then it turned out, from the feedback I got, I started calling people, I realized that even though they know from the training that 100 unit deal is easier, subconsciously and psychologically, they weren't ready for it, but yet they still wanted to do it. So they were sabotaging themselves. They were finding reasons not to do those deals. And then I thought to myself, well, these people are going through the same journey that I went on. What were the emotions that I had as I went through that journey? So I did what I was comfortable with. I did a small deal. I did a 3-unit deal, right? So I went back and I started teaching people, doesn't matter what size deal you do, the most important thing is that you do a deal, because your first deal is the hardest deal to do. So get that deal under your belt and then move forward from there. And you will start to, a 3-unit deal will get you, your next deal will be a 30-unit deal, because you have all the confidence, next deal will be a 100-unit deal. The one thing I know, you get into your first deal, and this has been proven over and over again, and this is exactly what happened to me. If you remember what I talked about at the very beginning of this, is when somebody does their first deal, their second deal is usually 2 or 3 months away. It comes very quickly. And the reason is because to do that first deal, you have to get your systems in place. You have to get your team in place. And then you have gone through the entire process and closed that deal. And now it actually works, and you have all the confidence in the world. But because the team and the systems are in place, that's why that second deal comes in, because you've already got the motor going, and then the third deal comes in, and then the fourth and fifth deal comes in. And then we get calls from clients that say, Dave, I got 5 deals going on, and I got to work on my systems. I got to work on my systems. And so that's usually what happens. So, for people just starting out, just work on your first goal is your very first deal. You may have a goal of, I want to have $10,000 a month positive cash flow, or I want to own 100 units or 1,000 units. Doesn't matter. First goal, first deal, doesn't matter what size it is.
And it sounds counterintuitive, right? I mean, it's just like, okay, how can a 100-unit deal be easier than a 10-unit deal, right? It does sound counterintuitive, but when you think about, you can give property management, you can assign property management to a third party, and all these different things. You have enough scalability there where you can have this thing operate. I mean, independent of you, so to speak, where you don't have to deal with the tenants, the termites, and the toilets every day. You can have enough money coming in. So those are some of the reasons, right? I mean, I know you can probably add on to that, but what?
Hold on, let me just say something, because it doesn't matter what size it is, you should be using third-party management, because you should be a focused investor on obtaining more deal flow and more deals coming in, and hand the management over to somebody else that, let them deal with the tenants, the toilets, and the trash.
Regardless of the size.
Regardless of the size. Yeah. 3. I mean, that's the mistake I made at the very beginning. I managed my own properties. And then when I read the ebook revisited, and when I realized this is not what I should be doing, that's when I started taking off. So always remember, and we have this saying here, right? And we tell our people that come through our Multifamily Millions Bootcamp, you got to go out and get third-party management when you first start off. If you don't, we will hunt you down and shoot you. We will put you out of your misery before you go into it, because of the fact it's so miserable, managing deals. But let me go back to why the bigger deals are easier. It's all about the money. Everybody in that team is paid based on the money. The broker is paid based on a commission on the sale of the property, the size of the sale. The management company is paid based on a commission of the revenues, which larger properties have higher revenues. The lender, their commission is based on, or they get a 1% a loan amount, and part of their commission is based on the size of the loan. And then you have your property inspector. He gets paid per door. So these people are getting paid more money, but in order to do these deals, they have to have like a higher intelligence. You know what I mean? They got to be a better business person. So you're dealing with better business people at this higher end instead of it's much harder actually to get a 3-unit deal done than it is one of these 100+ unit deals. The problem is, the mindset just isn't there for people that are just starting out. I remember my first 3-family property. That thing looked freaking huge. It was a flat top 3. I couldn't believe I was going to own this building. It was just enormous.
Yeah.
So it's mindset.
Yeah.
So what about money? I mean, I know we are starting off, and that those who are starting new, if they go into bigger deals, like 100-unit deals.
Yeah.
I mean, equity is always an issue. The capital stack is always an issue in the sense that, bank may give you the loan, but, finding the equity, especially with the current prices, $150,000 a unit, 100 unit, you are talking about $15 to $20 million project.
Yeah.
I mean, what is your take on the equity? Where does the equity come from?
There's two answers to that. One of them is to get an equity partner. And by the way, I love sponsoring deals. I like 100+ unit deals in emerging markets. So if anybody has a deal that they think works, call my office. I would love to sponsor your deal. But in reality, you don't want sponsors in your deals because sponsors take a cut of the deal, right? But you may need them to get started, but you want to be building up your own tribe. So you should be out there at meetups and, just talking to people. And at first I was so afraid. I'm an introvert, believe it or not. And I still hate networking. People I don't know, I hate going up to them. And at first I thought I was asking for money. Then I shifted my mindset to, I'm not asking for money. I'm actually offering opportunity. So I wouldn't ask anybody if they wanted to invest in my deal. I would just talk about the deals. Hey, this is what I do. I invest in this type of properties in emerging markets. And then they would start asking me questions and they would actually qualify themselves. But each person, I would get their contact information that was interested and I would put it in my database, and then I contact them once a month, let them know what I'm doing. And then when the time comes, it's like strike. So you got to have goals. So if you know that, your first goal is to do a deal that's $1 million. Okay. And you probably need about 30% of that is the equity you'll get from somebody else if you have no money. So that's $300,000. Well, the real formula is that you need to have at least $600,000 worth of commitments in your database to get that 300, because half the people, when you ask for the money, when you go back and say, hey, I got a deal, you ready to invest? Half of them will say, oh, no, I'm not ready yet. Oh, I don't have the money, but you don't know which half. And then some of them right before you're about to close will drop out. So if you're not prepared for that, you need to be. So with that formula that I just gave you, those are your initial goals as you move forward. And then as you keep doing it, you start doing deals, your investors become a really good source for other investors for you. And that's what you do. There's two things that you should always be focused on: finding deals, finding money, finding deals, finding money. And eventually you can get an acquisition team to start bringing you deals on a regular basis, but you should always be looking for sources of capital. Just like I said to you, I've been in this business for 20 years. We've raised over $200 million, right? And what did I say to you? Hey, you got connections in India? Because there's always deals going on to be had, and sometimes they're really big. I remember one time I was, this is when I first started out, and I was in Texas because I was buying a lot down there. And somebody said, hey, Dave, I want you to talk to this guy who's from Dubai. And he's an investor. He wants to put some money in the US. So he says, what size deals, how much do you want? What size deal? I said to him, what size deal do you want to do? He said about 25 million. And I thought, does he want to do a $25 million deal, or does he want to give me a check for 25 million? And that's what I asked him. He said, I want to give you a check for 25 million. At that point, I had not done a $25 million deal yet. You know what I mean? My raises were like 2 or 3 million. And I said, I'm sorry, I'm not the guy for you right now. I said, but maybe in the future, I will be your guy. That was my mindset. It's like, all right, maybe work up to that level. But so that's the opportunity,
I have a specific question. Some guys restrict themselves on a particular market, 1 or 2 markets.
Yeah.
What is your message to them? I mean, are they narrowing themselves, shooting themselves to death, struggling in those markets, or what's your thought?
It all depends on their, why they're in that one market or those couple of markets, and with the knowledge of market cycles, you can be making money in any of the 4 phases of the market cycle. So if somebody likes to be in a particular market for a particular reason, then you do the right strategy at the right time and you're making money. The difference is while that market's in 2 phases of decline, we're all running out after the other markets that are in 2 phases of emerging. You know what I mean? So we're moving our equity so we can multiply it. So, I never question why, if somebody's real motive is to generate as much wealth as possible in the shortest amount of time, then you need to be going from emerging market to emerging market. But if somebody is just comfortable being in a market and that's where they want to, stake their flag, or 1 or 2 markets, I'm good with that. I'll let people live their lives.
But there's no emerging market right now, just for next 3 to 6 months. There's nothing out there. I know people are doing deals, as you said, with the broker relationships, but as of right now, I don't see any path forward. Either they are declining or they are, at the bottom. Nothing has hit the bottom.
There's nothing running yet, but what
yes.
they're doing is they're in transition and they're getting ready to.
Yeah.
So there's still, like I said, there's still one-off deals there. The best deal you can do is a one-off deal in a market that's going to run. You make a ton of money, in that deal, because you bought it at really early going into the market and into the next phase.
What is your take on sub 50 unit deals, depressed assets or undervalued because of the distress at the seller? Not talking about 100 units. I'm talking about the deals we buy, we renovate like completely 50 units, 70 units, and boom, be ready when the market emerges in a year or so. What's your take on them?
I know people that are very successful playing that game. There's a guy right here in Massachusetts, and two of the guys in our Insiders Club that play that game. It's not a game that I play. I like the bigger deals because I like to be able to talk real time to my manager on site and get real time information. When you're in deals like that, 50 units, actually it's like 75 units and below, is 75 and above is when you can afford a manager. But so, somebody's not on site all the time, man. I don't like that. It's really, the bigger deals have better quality management. The smaller deals, it's hard to find good management for those smaller deals. So I like an easier life.
Dave, that kind of lead us into our lightning round of this podcast. One piece of advice that impacts your life and how you think it may benefit others. One good piece of advice you've received from someone in life and how it may help somebody else along the way.
All right. Here's the best advice that I can give you from the 20 years of teaching. And this works with anything in life. Is whatever you want to do, you've got to set your mindset up first. And you've got to be working on your mind from this day forward for the rest of your life, because that's the only thing that will set you up to be successful. Doesn't matter. I've got a proven system, for 20 plus years, we've been teaching it, so many successful people. But the thing that separates the people from that, from the very successful to ones that aren't, is their mindset. So there's a ton of good books out there. Dr. Joe Dispenza has a book, Becoming Supernatural. Esther Hicks has Ask and It Will Be Given. Go Google the laws of the universe, study the laws of the universe, especially frequency, the law of frequency. That is what will set you up for success in anything that you want to do in life.
Oh, that's awesome. That's awesome. Thanks for sharing that. Share one of the personal habits that contributes to your success, Dave, would you please? Like it's a daily habit or something like that.
I do gratitude. It might be a little cliche, but every morning when I wake up, before my eyes even open, when my consciousness, I know I'm awake, but I'm not. I say to myself, before any other thoughts can come in, this is going to be a great day. This is going to be a great day. And then I'll do I am affirmations. I'm a great real estate investor. I'm a great father. I am blah, blah, blah. And then I go into gratitude. I'm so thankful for. And I do that as I'm lying there. There's a good 5 or 10 minutes before you actually open up your eyes while you're still unconscious, and that really, the way where your brain waves are at that particular point, when you're just waking up or before you're going to sleep, that goes into your subconscious. So what you're doing is you're programming your subconscious for the rest of the day. I do the same thing before I go to sleep at night too. I think before I go to sleep, I vision what I want. I've got 3 major goals. Every year I have 3 to 5 major goals. I've got 3 major goals. And before I go to sleep, I vision that I have that goal presently, and I feel that feeling of having it. And then I slip into sleep. So I'm programming my subconscious mind, to be a stealth pilot and go out and get it. Works really well.
Wow.
I got that from Dr. Wayne Dyer, by the way. He's passed away right now, but he's got so much great stuff on the mind and mindset. Anybody should get his stuff and listen. It's awesome.
Dave, thank you so much. This is awesome. Paul, do you have any more questions for Dave?
No. You can go ahead, Prashant.
Yeah. So basically, Dave, again, as we said, You know, we are just so humbled that, you know, you took time to talk to our listeners. And I know this podcast will be published, and, you know, we are going to market it properly, but, you know, we cannot say enough thanks to you for taking time.
Oh, it's my pleasure. Anytime you want me on, just give me a buzz. It's fun.
Sounds good, Dave. Thank you so much.
Oh, but I got a
Dave,
question.
did you want to leave how our listeners can be connected with you in any way?
Yeah, sure. We've got I've got two ways. If you want to be an active investor or a passive investor that's looking to get active, you can go to rementor as in realestateinvesting.com. And we got a bunch of different programs in there that you might like. And then if you want to just be passive for now, you know, and invest in some of our deals, go to passivefornow.com. Passivefornow.com. Sign up. You can see our deals. It's not a commitment. It's just a sign up to take a look and see what we got. And if something tickles your fancy, you can invest with us.
Thanks, Dave. We appreciate your time. Thanks so much.
Thank you for tuning in to this week's episode of the Cash Flow Champs podcast. Cash Flow Champs partners with busy working professionals and entrepreneurs that want to build and maintain generational wealth through real estate. Visit cashflowchamps.com to learn more about us